TheoTrade. This is Don Kaufman. It's March 29th, 2023. We are just minutes after the cash close here on this Wednesday afternoon. It's a rally. I got to tell you, the sentiment, though, of overall markets this last couple of days, it's really negative out there. And that's why, of course, I'm going to theme this evening's video, a rally before a rout. Because you do have to kind of question, what are we rallying based on, right? Are we actually sounding an all clear on the front of financials? Meanwhile, it's the end of the quarter or very close to it, and could have some window dressing going on. For those of you that have absolutely no idea what I'm talking about with window dressing, that is portfolio managers that are latching on to, well, really well-performing stocks towards the end of the quarter, dressing the portfolio for the end of the quarter statements that we know are going to be going out. When you start looking around at stuff like Microsoft, which is up 17%, it rallied big today. You start looking around at stuff like Apple, excellent performance on the quarter, up some 30%. Everybody wants a piece of NVIDIA. All right, why? Again, you could actually constitute this as a degree of window dressing. And again, that terminology of window dressing that's an age-old term that deals with, again, portfolio managers that, look, it doesn't matter what you traded during the quarter. In the statement that goes out to your client at the end of the quarter, anything that's in the portfolio at that moment in time, okay, that's effectively all that does matter, right? That's what clients would see. So they call it dressing the portfolio. Nevertheless, we have a rip and rally inside of the S&Ps, but I had to tell you, trade overall, it is light and fluffy out there. I'm actually going to start this evening's update with a look specifically at the SPX, the mother of all products, and of course the weekly expected move. So today's move is a rip to the upside. S&Ps are up about 1.4%. However, as soon as I say that, all right, so it's good for 56 points. The expected move this week, though, is plus or minus right around like $89. Where are we right now? A little over halfway to the upside of the edge of the expected move. And again, the upper edge of the expected move is somewhere near 40.60, and that relates, of course, to the SPX. And the SPX is at a very different level, okay, than the S&P future. So don't confuse SPX and the SPOOs. The SPOOs are the S&P futures. The SPX, of course, is the cash-settled instrument that has nothing but an option marketplace, and they do trade effectively at different levels. Nevertheless, the reason I wanted to bring that up is when you're looking at this, you're like, it's a blistering rally. We're well within our means. We're well within the norm, because what we had on Monday and Tuesday of this week was absolutely unequivocally nothing. Now, on that particular tone, right? I'm kind of asking here, there's just so much bearish sentiment. Okay, I'm part of it too. I don't mind saying that. I still maintain quite a number of bearish positions, but I want to bring a few points up here. And it's one of the reasons I'm calling this the rally before the rout. There's a few aspects on the screen right now that are kind of, if you will, sounding the all clear. Like, that's it. The market's going to rally now. Everything's going to be fine. Of course, we don't have to hear from the Fed for, well, a couple of more weeks out there, not until like, it's more than a month away. It's early May before the next Fed announcement. Obviously, some data points coming out to some degree next week, but push all of it aside, because right now, what do we have ahead of us? Absolutely nothing but open territory and a marketplace that just hasn't moved a tremendous amount. So as I was saying a moment ago, there's this constant, almost like bearish sentiment coming out of the marketplace, and yet here we are with the S&Ps up 1.4%. Nevertheless, one of the first points to make is we are towards the upside of a channel that we have been in for a considerable period of time. We do have, in fact, a very marquee level just north of us. The marquee level relates to the S&P futures contracts, right? And that is ES, all right, 4106. All right, we're a little bit more than a hop, skip, and a jump north of that. But again, you get the picture, not too far off it. That would be indicative of, again, a more significant rally. But look, meanwhile, what, 40, 45 points away from that. That is achievable tomorrow and happens to be right up against the upper edge of the expected move inside of the SPX. So what I'm referencing in this case is that the 4106 in the S&P futures, okay, happens to correspond basically to the upper edge of the expected move in the SPX. I wouldn't be surprised at all if we went there. Now, as I was saying, there are some indicators on the screen here that are kind of sounding the all clear. The first one I want to jump to is volatility. Now, for those of you that know, okay, and tune into these videos frequently, I'm not much of a VIX kind of a guy, but a lot of people are looking at VIX and thinking, oh, look, Don, hey man, like the volatility has collapsed back down. How can I not agree? I mean, I'm looking at it too. I'm like, all right, we're up here at 28 level. VIX has collapsed back down to 19. This is one of the lowest realms that the VIX has been in quite some time. In fact, I'm going to go out and here on a limb, and it's one of the reasons you guys tune into these videos, okay? I actually like long VIX trades right now, okay? Long VIX trades. And to get really specific in here, I wouldn't go out more than about 48 days. When you go about 48 days, first of all, the 48-day options are not priced, and this is critically important if you ever trade VIX, okay? The options that are out here 48 days are not based on a 19 VIX. They're actually based on the volatility futures contract that expires, 49 days from now. So when you're looking at options in VIX, VIX options do not correspond to the price, okay, or spot price of VIX, and that confuses everybody. But okay, the VIX is much closer, okay, between the 22 and 23 region. In fact, if you really want like specifics, where is the forward VIX? And the answer is 2213, right? So 2213 is where spot VIX, okay, well, I should say the futures of the VIX is where spot VIX is actually at 19. You're like, oh, that's confusing. Basically what it's saying, okay, is yeah, VIX is low right now, but 48 days from now, it is anticipated to pick up. And it's very common. It's like what we call the contango in here. Nevertheless, I'm going to build some trades tomorrow morning. As long as markets are up, I'm going to build some trades, some bullish trades tomorrow morning in VIX, and I'm going to finance them through means of Catapult. So I got that going for me. We'll go ahead and build a couple VIX trades tomorrow. I think it's going to be a pretty decent time to do so, and not necessarily because I think the marketplace is going to tank. And again, I don't want to be taken the wrong way over there, but to me, VIX has come down considerably. And VIX, if you just looked at VIX, you're like, okay, it's sounding the all clear. But there's an issue in here. What's not sounding the all clear is the bond market. Bond market is still extraordinarily guarded. Bonds just rally back up, a hop, skip, and a jump, and all of a sudden the bonds have broken out to the upside. Meanwhile, the bonds could actually break to the downside. If the bonds break to the downside, that means rates are going to go higher. If rates are going to go higher, it's probably going to crush some of the technology stocks. Right? We're in a little bit of a catch-22 over here. Bonds, okay, are not sounding an all clear. VIX is sounding all clear. Meanwhile, wait, there's more. If you take a look at gold, gold is still threatening a major breakout. Now, here's one we already have. We have a bullish trade on gold, and it's for that, and it's that alone, for the possibility of a breakout. So again, it's a marketplace. That's why I'm calling it a rally before a rout. Everybody has to question the current rally. You also have to look at this for what it is. If you look at financials, come on, they're just still a hop, skip, and a jump off some of the recent lows. If you take a look at the energy sector, it's fared a little better. It's actually got quite the rally under it. Nevertheless, okay, this rally has kind of left us, a little indecisive, maybe wanting a bit more here. I would not be at all surprised, okay, to see a rally right up to that primary gravity point of the 4106 prior to coming back off. Nevertheless, I believe we're still incredibly range bound at present time. And look, don't go out on a limb and make, if you will, that assumption that, okay, we're headed back to the upside. Whatever you're doing out there, keep the risk under control. Sell premium, okay, when we hit the upper end or lower edge of an expected move, and get back. And again, keep that risk under control right now, because we're not home yet. We have not sound the all clear in a number of asset classes. Just because volatility happens to be down, right? That's just not enough to go on. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.